Hi everyone, very good evening. So, continuing with our revision slot, I am taking up three simple chapters, three simple topics: clubbing of income, set off and carry forward of losses, and a small topic of CA final which has come down to the CA intermediate level, alternate minimum tax AMT. Concepts are pretty simple: clubbing of income, and the second chapter, set off and carry forward of losses. They come up in your exams with a regular frequency. Either you have a question based on clubbing or you have a question based on set off, and you will find many question papers where you have a question on clubbing and set off both in the paper. So frankly speaking, it will be really fortunate, you will be really lucky if you have one of these two chapters in your question paper. When you talk of clubbing of income, it means there will be minimum two persons involved in the transaction. Somebody will be receiving the income, but the person who receives the income is not going to be the person who is going to pay tax. Tax is going to be paid by somebody else. Income Tax Act has specifically created sections so that clubbing provisions, when they get attracted, the right person is going to be charged to tax. It is the correct person who should be brought to tax. The range of sections here are from section number 60 to section number 64. It is section 64 which is the main section, which has various subsections and clause numbers to study. First three sections, 60, 61, 62, they are pretty simple, pretty easy to tackle. Certain things that you must remember when it comes to clubbing. Clubbing will only be done of taxable incomes. Exempt incomes will not be subject to clubbing. If an income is exempt under section 10, it is exempt for person number 1 also and person number 2 also. So clubbing provisions will not apply to exempt incomes. Clubbing provisions will only apply to taxable incomes, only if an income is taxable. Second, clubbing of income decides the person who is going to pay tax. According to the section of clubbing, who is the correct person to pay tax, that will be decided. So computation does not change. If an income is subject to clubbing and it is taxable as IFOS, so the head of income will remain as IFOS only. Any expenditure which is going to be allowed as a deduction will be allowed. Any expense which is to be disallowed will be disallowed also. So clubbing does not affect your computation. Clubbing does not affect the taxability of income under a particular head. Expenses which are generally allowed will be allowed even if clubbing applies. The word used in the chapter is clubbing of income. When you say clubbing of income, the word income includes losses also. By doing an activity, I can have a profit, I can have a loss. Profit, I will pay tax. Loss, I will set off the loss, I will carry forward the loss. So clubbing of income does not mean we are going to restrict ourselves only to incomes and profits. Even losses will be covered by the chapter of clubbing. So if person number 2 in my example suffers a loss and the provisions of clubbing are applicable, then it will be person number 1 for whom the loss will be considered. Person number 1 will set off the loss, person number 1 will carry forward the loss as if it was his own loss. So profits, losses, everything will be clubbed. It should be a taxable income, a taxable source, then clubbing ka section will apply. Quickly going through the section of clubbing, quickly going through all the provisions. First, three sections can be studied together. Section number 60, 61 and 62. There is a simple pattern. In section 60, there is only transfer of income, but there is no transfer of asset. That means the asset remains with the transferor, but the income is received by the transferee. So, but of course, transferee is receiving the income, but he or she does not have the asset. Then just because you receive the income, you are not going to pay tax. This income will be taxable for the transferor. The asset is retained by the transferor, but the income is transferred to the transferee. So what will be the tax effect? What will be the conclusion? Such income will be clubbed, will be added to the income of the transferor. Transferor will pay tax on his own income and this income which has been received by somebody else, but the asset is with me and I am the transferor of that asset. The income is received by somebody else, I am the transferor, that income will be included in my computation. Section 61 goes a step ahead. It says that there is a transfer of asset, no doubt, but the transfer of asset is a revocable transfer. Revocable transfer means it is a cancelable transfer. It is cancelable. The transaction can be reversed. The transaction can be cancelled by the transferor, which means what will happen is that originally transferor is transferring the asset to the transferee, but because the power of revoking, cancelling is with the transferor, at any given point of time, transferee might have to return the asset back to the transferor when that revocation happens. So when this is the whole situation, asset is with the transferee, so transferee receives the income from that asset during the year, but the control of that asset is with the transferor. The power to revoke lies with the transferor, and therefore the income will be clubbed for the transferor. Even though he has not received it, he will be paying tax. 62. Now we are saying that there is an irrevocable transfer. Asset is transferred, but asset is transferred in an irrevocable manner, in a non-cancelable manner. But it is non-cancelable, it is irrevocable for a specified period only for a fixed period, and that period is defined in the section, which means during this period the transfer cannot be cancelled. The asset will remain with the transferee, which means whatever income arises, this income will be taxable for the transferee only. But after the specified period gets over, the power of cancellation is now active. The transferor of the asset can use the power, and if he wants, he can take the asset back. So now it is no longer irrevocable, it has become revocable. So thereafter the income will be taxable for the transferor. There are three situations covered by the section. Number one, transfer of the asset is made before 1st April 1961, that is before this Income Tax Act came into existence, and it is irrevocable for a minimum period of 6 years. Number two, it is irrevocable during the lifetime of transferee. So long as the transferee is alive, the asset will remain with the transferee. The transferor cannot take it back. Third, the transferee is a trust. Asset is transferred to a trust, and it is irrevocable during the lifetime of the beneficiaries, the persons who are going to gain benefit from that asset. Beneficiaries are those persons who will derive benefit from these assets. Till the time the beneficiaries are alive, the transfer is irrevocable, the asset will remain with the trust. So that is a specified period. In point number 1, 6 years minimum is the specified period. In point number 2, lifetime of transferee is the specified period. And in point number 3, lifetime of the beneficiaries is the specified period. These are the specified period, and so till the time the specified period is going on, during the specified period, income will be taxable for the transferee during the specified period, and after the specified period gets over, income will be taxable for the transferor. Last point to understand here, these three points 1, 2 and 3, they are not any examples, they are mentioned in the section itself. So if there is any transaction, any transfer of an asset which does not fit up in these 3 points, then section 62 does not apply only. And if section 62 does not apply, then the transfer is treated as revocable transfer from the beginning itself. That means section number 61 will apply. Every year income will be taxable for the transferor of the asset. There will never be anything taxable for the transferee. Section 62, the section that we are studying, will apply only in these 3 situations. So first 3 sections, quick summary: income is transferred but asset is not transferred, section number 60. Asset directly is transferred but it is a cancelable transfer, 61. 62, asset is transferred but it is non-cancelable for a fixed period, for a specified period. After that it becomes cancelable. Chalo, going ahead. 64.1.2. Now this section many a times comes up in your paper. 64.1.2. The spouse is earning some remuneration, and that remuneration is being clubbed with the individual. Okay, now what is this? Very simple. Number 1, the individual should have substantial interest in a concern. What do we mean by all of this? Having substantial interest means you have minimum 20% of voting power or 20% of profit sharing ratio. What do I mean by a concern? Very easy to understand. Concern will mean a company also, and will mean a non-company organization like a partnership firm, AOP. I am having substantial interest in the concern. I am the individual who is having substantial interest. I can influence the concern. The spouse of the taxpayer is earning salary, fees, commission, remuneration. Basically income for efforts. It's a very loose way to describe, but the nature of income should be salary, commission, fees, any type of remuneration. But the problem is that the spouse does not possess the qualification, the knowledge, the technical experience that is needed to justify this remuneration. Now in this situation, what is happening is that the person who is receiving the income is the spouse, but the person for whom this income will be taxable is the individual. Individual has substantial interest, condition number 1. From that concern where the individual has substantial interest, the spouse is receiving remuneration type of income. And condition number 3, spouse does not possess the qualification needed. If all these conditions are satisfied, income will be clubbed. It will be clubbed for the individual. Remember, it is not husband wife, it is individual spouse. The individual should have substantial interest, could be the husband, could be the wife. If all these conditions are satisfied, only then clubbing will apply. That means that if any condition is not satisfied, clubbing will not apply. That does not mean that the income becomes exempt. Income will be taxable for the receiver. This is the general rule applicable in the entire chapter of clubbing. If the clubbing section does not apply, then the taxable income will be taxable. It does not become exempt from income tax. The one who receives the income is going to be the person who is going to pay the tax. Number 1, substantial interest. Number 2, remuneration. Number 3, no technical qualification or experience. If all 3 conditions satisfied, clubbing will happen, individual will pay tax. If any condition is not satisfied, spouse will pay tax. Head of income here will be salary, in all probability, salary, job. So all the deductions, exemptions that are available in the salaries chapter will be available here also. It is only the final taxable salary which will be brought to tax, which will be clubbed for the individual. What do I mean by substantial interest? Important definition. Individual has substantial interest if it is minimum 20%. We've already seen that. But it should be either individually or along with relatives. So as an individual, I may not necessarily be having the entire 20% or more than that. My own stake could be less than 20%, but my stake along with the stake of my relatives, if the total is 20% or more, then it means I have substantial interest, and therefore condition number 1 of the section will get satisfied. If thereafter condition 2 and 3 also get satisfied, clubbing will happen. Relative means husband, wife, brother, sister, lineal ascendant, lineal descendant, which means parents are covered, children are covered, grandparents will also be covered by this definition, lineal ascendants. Individual all by himself satisfies the criteria of 20% or more. Or alternative 2, individual's share plus the share of his relatives put together is 20% or more. Then it is said that the individual has substantial interest, and if he has substantial interest, clubbing of income, the section will apply if other conditions are satisfied. Okay, moving ahead, an important section. In fact, this section is the base of the entire chapter. Section 6414. We are talking about an individual giving an asset to spouse. The individual has transferred the asset. So we can call individual as the transferor. Asset is transferred to spouse. So spouse is the transferee. The asset is transferred, this is important, for no consideration or for inadequate consideration. All assets are covered in the section except for house property. The reason being, house property is covered by section number 27. An identical situation, the situation that is described in 6414 is replicated in section 27 also, that is house property chapter. So section 27 covers house property as an asset, and every asset other than house property is covered by 6414. Individual is transferring an asset to his or her spouse for zero consideration or for inadequate consideration. At the time when the transfer happens, is happening, the husband-wife relationship is continuing, should exist, and the husband-wife relationship should also exist at the end of the year. This is another condition that I got to satisfy. If all the conditions are satisfied, then income will be received by the spouse but will be clubbed with the individual. The individual who has transferred the asset will be responsible to pay tax. Income will be received by the spouse because the spouse has the asset, but the asset is received by the spouse for no consideration, for inadequate consideration. So it is the individual who has given this benefit to the spouse, and therefore the individual will be responsible to pay tax. Small points that I would like to highlight here. When you say income, the word income means the net amount after all deductions and exemptions that will be possible under a particular head of income. And also remember that when I'm talking about income, I am talking about PGBP as the head, capital gain as the head, IFOS as the head. See, house property anyways is excluded in this section, so we cannot talk of house property. Salary income is not something that you will derive from an asset. Salary income is something that you will derive when you make efforts. So salary and house property, two heads are excluded in this section. It means I am talking about PGBP, capital gains and IFOS. I have given an asset and that asset is invested in business, PGBP income. I have given an asset to spouse, spouse has earned capital gains from it, that also will be covered in clubbing. I have given an asset, spouse has invested that asset somewhere and is deriving IFOS income, then that IFOS income is also covered by this section. Net amount after all deductions, exemptions, etc. will be brought to tax. The person paying the tax will be individual. Again, it goes without saying that there are three conditions for the section to apply. If any one of these three conditions are not satisfied, then clubbing will not apply. And then clubbing will not apply, which means income will be taxable for the spouse. So in simple terms, I could say that if 6414 is not applicable, then income is taxable for the spouse. It is the spouse who is going to pay the tax. If the amount is invested into business, the income that I am having is PGBP income. So individual has gifted some asset to the spouse and the spouse has thereafter invested that asset into the business. That asset could be money. In fact, that asset could be something in kind also. Money or asset in kind is invested into business. Business will generate profits. Certain part of the profits are derived by the spouse's own money invested, own capital. But certain part of profits can be allocated, can be attributed, can be connected to this asset that the individual has given as gift. So clubbing will apply, but clubbing will apply on a proportionate basis. And what is the proportion? I will calculate the gift amount invested in the business, compare it with the total investment in the business. The important point to understand is that this comparison is to be made as on the first day of the previous year, beginning of the financial year. As at the beginning of the financial year, if the asset is invested by the spouse in the business, then for that financial year, whatever profit arises, that profit will be that profit will be subject to clubbing on a proportionate basis. Balance profit will be taxable for the spouse. Amount taxable for the spouse will be taxable PGBP income minus the amount that is clubbed as above. Balance profit will be taxable for spouse because that profit is arising to the spouse out of spouse's own capital. But the money that is given, the gift that is given by the individual is also now part of the capital of the spouse. And so you have to understand that a proportionate basis clubbing will happen. For sum solving, just got to take care of one thing. When you say that there is total investment in the business as on the first day of the previous year, you have to consider the following things. Number one, you have to consider the opening balance of the preceding year. If I want to calculate the total investment as on 1/4/2020, I have to also take into account last year's capital account and see what is the movement in the capital. What is the movement in the capital? I will have to take into account the opening balance of the preceding year. This is also one thing that should be considered. Then you will also have to take into account capital introductions. You will also have to take into account drawings. You will also have to consider the profit or loss that is credited or debited into the capital account. Many a times what the question tells you is, it gives you information not only about the current year but also 1 year prior to that, and it is asking you what will be the situation in the current year, will clubbing apply or not. So you will require the opening balance as at the beginning of the current year, which means you will require closing balance of the last year. For that purpose, you will have to take into account all these things. You will have to prepare a proper capital account. You need not prepare it properly and show it in the solution. You can just do it as a rough working. But in your mind, you will have to take into account everything that is debited or credited to the capital account. This is what happens when money that is given or asset that is given by individual to spouse is specifically invested into the business. If it is invested into the business, then this proportionate clubbing formula will apply. Situations where clubbing will not happen: if asset was transferred before marriage, then but obviously clubbing provisions will not apply, because there was no husband-wife relationship existing at the time of transfer of the asset, which means condition number 3 has got violated. If assets are transferred for adequate consideration, that means the spouse has paid the full market value. Now condition number 2 has got violated, so no clubbing. If assets are transferred in connection with an agreement to live apart, which means there is no husband-wife relationship existing, again I can say condition number 3 is violated. At the end of the financial year, there is no husband-wife relationship existing, there is a divorce happening, and as a result of that divorce, the husband gives a particular asset to the wife. The wife does not pay anything, it is given as alimony, but wife does not pay anything. This asset cannot be taken into account for clubbing purposes. Income derived by the wife will be taxable for the wife only. If on the date of accrual of the income, transferee is not the spouse of the transferor, transferee is not the spouse, that's what I meant when I said divorce. If asset is acquired by the spouse out of pin money is husband giving a certain amount to the wife for the wife's personal household expenses. Now that is not asset gifted. If a part of that pin money is saved and from that savings an asset is acquired, there will never be any clubbing when that asset generates income. That income will be taxable for the spouse only. It is spouse ka own savings which is generating income. If income is arising from accretions to asset, accretions mean an increase to the asset. So if the asset is gifted and then there is an increase arising from the asset, income will be clubbed. But from the increased component, if there is any income generated, that will not be clubbed, that will be taxable for the spouse only. No clubbing for the accretion which is generating income thereafter. This is 6414. 6414 is the base for 3 other sections that we are about to study. 6416, instead of spouse in clause number 4, there is son's wife. Individual is transferring an asset to son's wife. This time every asset including house property is considered. No consideration, inadequate consideration still remains the same. Income is received by the transferee but will be clubbed with the transferor. All the points of 6414 will apply to 6416 also, but the only difference is, number 1, instead of spouse it will be son's wife, and number 2, house property here is also included in the section. The concept of deemed owner under section 27 does not cover this. 6417, individual is transferring an asset to any person, but the condition is that the income from the asset should be used for the benefit of spouse of the individual. So 6417 is the indirect version of 6414. In clause 4, we gave the asset to spouse. In clause 7, we are giving the asset to somebody else, but we are telling that person, use a certain part of the income for the benefit of my spouse. So indirectly the benefit is going to the spouse. That means to the extent the income is utilized for the benefit of spouse, that much income will be taxable for the individual, balance income will be taxable for that person. And 6418 is the indirect version of 6416. In 6416, we gave the asset to son's wife. In 6418, we are giving the asset to any person, but we are saying use the income for the benefit of son's wife. So indirectly, the benefit is being passed on to the son's wife, and therefore clubbing will apply. Individual will pay tax on that portion of income which is being used for the son's wife every year. It is that income which will be taxable for the individual, balance income will be taxable for that transferee, that any person. So 6414 spouse, 7 indirectly spouse, 6 son's wife, 8 indirectly son's wife. Everywhere the person paying tax is individual. In clause 4, house property is not covered. In 6, 7 and 8, house property is covered. Moving on to the next section. Even this is something important. This also comes up in your paper quite frequently. Minor's income. Minor's income will be taxable in the hands of the parent. Minor will not pay tax. General concept. Minor's income will be clubbed with the parent's income. Now which parent? Father or mother? So if the marriage between the parent is subsisting, then it will be clubbed in the income of that parent whose total income is greater, is higher. Here the small thing to mention, I am sure you guys remember, first you must do clubbing between the parents if it is applicable, which means I am talking about 6412 substantial interest, no technical knowledge but deriving remuneration. 6414 asset gifted to spouse and spouse is deriving income out of it. 6417 indirect version of 6414. First do clubbing between the parents, and after that you give effect to this section 64(1)(a), that is a minor's income. It is possible that husband's income is taxable for the wife because of a section of clubbing. Vice versa, it is possible that wife's income is taxable for the husband because of a clubbing section. First give effect to those clubbing sections, then check whose income is greater, and after that you select that parent and add the minor's income, club the minor's income for that parent. This rule is applicable if the marriage of the parent is subsisting. If the marriage of the parent does not subsist, they have separated, they have divorced, then the parent who maintains the minor child will be responsible to pay tax on that minor's income. Then the minor's income will be clubbed for that parent who maintains the child. Father or mother, whoever maintains the child, will be responsible to pay tax on that minor's income. By chance, if the parents are not alive, then remember there is no clubbing. You will not club it with the guardian. You will not club it with the relative who is taking care of the minor. This is a very common misconception that many students have. Parents are not alive, no clubbing of income. There will be no clubbing at all. Income will be taxed in the hands of the minor. Minor by himself or herself is also an individual whose age below 18 years. So I can also write down that the age is below 60 years. What I mean by this is that basic exemption limit applicable will be 2,50,000. If clubbing does not happen, income is taxable for the receiver. This was the general rule that I had mentioned some time ago. That rule is applicable here. Parents are not alive. Minor is surviving all by himself or herself, or maybe being taken care by a relative. The relative, the guardian, will act as a representative assessee, will do the formality of filing return, but clubbing will not be done for that guardian. It will be treated as a minor's income only. Minor will be responsible to pay income tax. You calculate income tax according to basic exemption limit of 2,50,000. So tax liability will arise only if the minor's income exceeds 2,50,000, that too as per slab rates. Otherwise, income will be, the final tax will be zero, but guardian will not be responsible to pay the tax. Clubbing will not apply. If you do clubbing, then as a parent, you will be entitled to an exemption under section 10 subsection 32 for the income of the minor. Maximum 1,500 ka exemption will be available, and it is per child, not per income. If there is a minor who is having 5 incomes, you will not get an exemption of 1,500 into 5, 7,500. Nahi. Exemption will be 1,500 only. If a parent has 3 minors, then for each minor's income, there will be a 1,500 exemption available individually, separately. But you will have to do the working separately, section 1032 ka working. Whenever you do clubbing, then this exemption will be available. Exemption will be available only and only if you do clubbing. Some situations where 64(1)(a) shall not apply. Income of the minor shall not be clubbed. If the minor is suffering from a disability covered under section 80U, then all type of incomes will never be clubbed. It will be taxed for the minor. Minor will take a deduction under section 80U. Balance amount remaining, minor will pay tax. Of course, there will be a representative assessee who will do all the formalities. Second, if the minor is earning income on account of any manual work, on account of skill, talent or specialized knowledge, then this income will not be clubbed. Here you can very easily understand it something like this, that income under point 2 and point 3, they are active incomes. The minor has to do some activity, active, that's how I am deriving the word. The minor has to do the activity to earn the income. Then active incomes, there will be no clubbing. If the minor earns passive incomes, then yes, passive incomes definitely will be clubbed. But if you are a minor who is suffering from a disability under section 80U, then income from all sources, meaning whether it is active or it is passive, neither of the incomes will be clubbed. So a normal minor who does not suffer from any disability, active income not clubbed, passive income clubbed. A minor who is suffering from a disability, no clubbing at all, neither active nor passive, no clubbing at all. This is your 64(1)(a). Last section in the chapter of clubbing. A Hindu undivided family is receiving an asset from its members, from one of its member, any member, karta, co-partner, anybody is covered. Any asset is covered, including house property. How is this asset transferred? This asset is transferred either for no consideration or for inadequate consideration. Then, as every clubbing section goes, income will be received by the transferee, in this case HUF, but the income will be taxable for the member, the one who has transferred the asset. The second part of the section goes ahead and says that when this HUF is partitioned in future, partition happens in future, that is when the second part of the section will get attracted, then income from this particular asset meaning the asset which was transferred by the member, this income which is received by the spouse, whose spouse? The spouse of that transferor member, this income will be clubbed for that transferor member. So here in a way you can also understand this is indirectly spouse ka income being added to the individual's income who was the member, but the difference is first the asset was given to the HUF. On a year-to-year basis, HUF received the income. As a member, I paid tax. Some years later, when the HUF got partitioned, then whatever asset from this asset, whatever share was received by my spouse, that will generate income. That income will be clubbed for me as the individual, me as the original member who had transferred the asset to the HUF. Important sections in this particular chapter from an examination perspective: 64.1.2, 64.1.4 and the section of minor 64.1a. These are the three sections which frequently appear in your question paper. If you are going to practice any sums or if you are going to go through any sums, please ensure that these three sections are studied properly. Chalo, this brings us to the end of clubbing. Now let us start with set off and carry forward. Now see, in set off and carry forward of losses, some students face a problem in solving questions primarily because they don't follow certain basic rules, certain basic concepts. So unnecessarily the chapter of set off carry forward becomes complicated for the student. Some small points to remember. When you talk of losses, when you talk of this chapter as a whole, you must always keep in mind your heads of income. While you solve, while you present your answer, while you think about the pattern of set off, keep in mind the heads of income. First head of income, salary. Salary can never have a loss. You are doing a job somewhere, you will receive salary, it will never have a loss. You will never have loss computed. Salary will always give you a profit. Second point, when you earn winnings income, lottery, puzzles, games, gambling, betting, casual winnings. In case of casual winnings, expenses are never allowed as a deduction. So if you win, you have a profit, you have a positive answer in calculation. If you don't win, expenses never getting allowed as a deduction, your calculation will give you zero income. So there will never be a loss in casual winnings. Third rule, you cannot set off any loss against casual winnings. No loss can be computed under the head salary. There is no loss under casual winnings which can be set off and carried forward, and no loss under any head can be set off against casual winnings. These are three general rules that you can keep in mind before you even start studying the provisions. Lastly, the loss that you are talking about should be from a taxable source and not from an exempt source. If profit is exempt, then loss cannot be used for set off carry forward. Agriculture activity giving me profit, I don't pay tax. Then agriculture activity giving me a loss, that loss cannot be considered for set off and carry forward. It has to be a taxable source. Now, the shortcut, the pattern to solve questions can be summarized into something like this. You will be doing the set off, a question will be given to you. where you will be told this is the current year's loss, this is the brought forward loss, this is loss under a particular head. So the rule is very simple. First, you will set off current year amounts. Current year's items will be set off first, and only then thereafter you will bring into picture the past year's losses, would be a wrong word, let me say past year's items. First of all, you are going to give effect to the current year items. Now in the current year items, the sequence that you will be following is, number 1, you will give effect to current year's depreciation, section 32(1). Number 2, you will do inter source adjustment. This is section number 70. And number 3, you will do inter head adjustment, that is section number 71. After doing all of this, you will then bring into account, you will then bring into picture past year's items, and in past year's item the sequence will be brought forward losses, and the last thing will be your unabsorbed depreciation. Brought forward losses will be from section number 71B to section number 74A. Unabsorbed depreciation will be section 32 subsection 2. So this actually is your sequence. This is your sequence of set off and carry forward. First you will give effect to current year item, and even in current year you will do depreciation of the current year first, that will be under the head PGBP. Then you will do inter source adjustment, then inter head adjustment. Okay, now let's try and figure out, let's try and understand what these things are. I have tabulated everything in the notes. What the Income Tax Act has done is, it has given me rules and regulations that I have to follow for doing set off carry forward, and the best way to study them is to focus on the restrictions put. The Income Tax Act has said this loss can be set off against this profit only, this loss cannot be set off against that profit, this loss can be set off against this profit only like this. Remember the restrictions. Everything else has to be dealt with normally. I'll give you an example. First thing that we are studying is inter source adjustment. Okay, so what is inter source adjustment? Under a head of income, you have two sources. One source has a loss, other source has a profit, you can adjust. Under house property, you have two properties, one property loss, another property profit, you can do set off. This is inter source adjustment. You are doing two businesses. Under the head PGBP, two sources, one business, second business. Second business has a loss, first business has a profit, you can set off. You have sold two capital assets. One has given you a capital loss, other has given you a capital gain, you can set off. Now this is the general rule. Loss from one source can be set off against profit from another source. Both the sources fall in the same head of income. So when I am talking about inter source adjustment, I will say that this source that I am talking of, just a minute, this source that I am talking of, this source falls in the same head of income. Now what are my restrictions? I told you it is best to go in the sequence of heads of income. Salary will never have a loss, so forget salary. House property, no restrictions. No restrictions at all. One house property's loss can be set off against other house property's profit. SOP loss can be set off against LOP. LOP loss can be set off against LOP profit. DLOP loss against LOP profit. SOP loss against DLOP profit. Nothing to think. You find two house properties, one as a profit, another as a loss, you can set off. Finished. PGBP. If you have a loss from a specified business under 35 AD, then it can be set off only against profits of specified business. So 35 AD ka loss can be set off against 35 AD wala business ka profit only. So this is, if I say that way, this is restriction number 1 to remember. Restriction number 2, speculation loss. So by speculation loss can be set off only against speculation profits. So if you have a speculation loss, you require a speculation profit to be able to set off that loss. Speculation against speculation, specified against specified. Speculation loss against speculation profit, specified loss against specified profit. Non-speculation loss, this is my normal PGBP loss, normal business profession loss. This can be set off against all business profits, can be set off against non-speculation profit also, can be set off against speculation profit also, can be set off against specified business profit also. Everything is possible. So there is no restriction here. Two businesses, one is a non-speculation business, it has a loss. That loss can be set off against the second business ka profit. That business could be any business, speculation, specified, non-speculation, does not matter, set off is possible. So if you have a specified loss, you need a specified profit. If you have a speculation loss, you must set it off against speculation profit only. But if you have a non-speculation loss, it can be set off against all three types of profits. Capital gains as the fourth head of income. Short-term capital loss, no problems, can be set off against both short-term and long-term, normal case. Any capital loss against capital gain, possible if that capital loss is short-term. But if that capital loss is long-term in nature, then long-term can be set off against long-term capital gain only. That means, if you think like this, long-term capital gains against short-term capital loss, the answer is not possible. Long-term capital gain against short-term capital loss, sorry. Long-term capital loss against short-term capital gain, not possible. Short-term capital loss against long-term capital gain against short-term capital gain, very much possible. Long-term capital loss against long-term capital gain, yes, possible. Under the head income from other sources, if you have loss from the activity of owning and maintaining race horses, just a quick word, I'm sure you guys remember this small thing. Loss from activity of owning and maintaining race horses is not casual winnings. The computation in this case will be done as stake money, which is also called as prize money, minus the expenses that are incurred on maintenance of those horses. But of course, when we talk of these expenses, they are all revenue expenses. So expenses are allowed as a deduction, and so you can have a profit also, you can have a loss also. Now if you have loss from the activity of owning and maintaining race horses, it can be set off only against profit from that similar type of activity. But if you have any other loss under the head IFOS, then that can be set off normally against every IFOS income, including profit from OMRH. So, in a way, if you think about it, I could put it something like this. that a quick summary of section 70 would be the restrictions that I got to remember are speculation loss against speculation profit only, specified business loss against specified business profits only, long-term capital loss against long-term capital gains only, and owning maintaining racehorse ka loss can be set off against owning maintaining racehorse profits only. Everything other than this is normal thinking. Take a loss, find the profit, both fall under the same head, do the set off. But if these are my losses, I have to be very specific, I have to be very accurate, I have to take care when I do the set off. This is the first section, section number 70, inter source. Now I go to inter head adjustment. What do I mean by inter head adjustment? So by inter head adjustment simply means that there is loss in one head and there is profit. Just give me a second, please. There is loss in one head, there is profit in another head. Set off is being done amongst the heads of income. One head has given me a loss, the other head has given me a profit, and I am doing the set off. Now here the restrictions are simple enough to understand. See, we saw that specified business ka loss can be set off against specified business profits only. So the balance 4 heads of income, salary, house property, capital gains and IFOS, those 4 heads are not specified business. That means inter head adjustment is not going to be applicable only, it will straight away be carried forward. Speculation loss can be set off against speculation profits only. So the other 4 heads are not speculation. That means I cannot adjust speculation loss against salary income, house property profit, capital gains wala profit. They are not speculation in nature. So straight away carry forward them. Owning and maintaining racehorse activity. In this entire chapter, OMRH, owning and maintaining racehorse activity, is treated equal to speculation. Provisions for OMRH are ditto, identical to speculation. Section number is the only difference. So loss from owning maintaining racehorse activity cannot be set off against other heads. Straight away you have to carry forward. Next restriction, under the head capital gains, short term, long term, both are covered. You cannot set them off against other heads of income, because generally speaking I can say that the balance 4 heads are revenue in nature. This is the only head which is capital in nature, and so therefore short term and long term capital losses cannot be adjusted against other heads of income. You will straight away carry forward them. Last restriction, 2 more restrictions to study. If you have loss under the head house property, that loss can be set off against other heads of income only up to 2 lakh rupees. Balance loss will be carried forward. In future, you will set off that loss. So if my loss under the head house property is 2,10,000, then 10,000 will be carried forward. Set off possible is only up to 2 lakhs. A house property loss can be set off against salary, against PGBP, against capital gains and against IFOS. But there is an amount restriction of 2 lakh rupees maximum. Beyond that, if you have suffered a house property loss, it will have to be carried forward to future. And the last restriction put up by the section is that non-speculation losses cannot be set off against salary. You can set it off against the other 3 heads, but you cannot set it off against income from salary. So technically, if I have to quickly summarize section number 71, I can say that there are 4 losses: speculation, specified, OMRH, owning, maintaining, resource activity, short term and long term. These will be straight away carried forward. Restriction number 1. Restriction number 2, any non-speculation loss against salary, this is not permitted. And restriction number 3, that house property loss can be set off against the balance 4 heads, but up to an amount of 2 lakh rupees only. Balance house property loss will have to be carried forward. This is your section number 71. And when it comes to carry forward concepts are actually very simple. For carry forward, I'll give you a small hint to focus on. When you talk of carry forward of losses, remember those losses will be carried forward. In future, they will be set off. So the rule is that they will be set off against, sorry, just give me a minute. They will be set off against same type of profit, or I can write down same head of income. Carry forward losses, there is no concept of inter head. So if house property loss, please remember this and please understand this properly. House property loss brought forward today can be set off against house property only. PGBP loss brought forward can be set off against PGBP profits only. Speculation loss brought forward can be set off against speculation profits only today. The confusion that I am trying to avoid, many students tend to have this confusion. That is the thing that I want to avoid. What I am trying to explain to you guys is, look at it like this: house property loss and PGBP income. If house property loss is of the current year and PGBP income is of the current year, both profits and losses are of the current year, then my question, is the set off possible? The answer is yes, it is possible under section number 71, inter-head adjustment. But if I have house property loss of the past year and PGBP income of the current year, then remember कि by this set off is possible? No, this set off is not possible. That means house property loss brought forward means I'm talking about past. Brought forward house property loss can be set off against current year's house property income only. If profit and loss both belong to the same year, then you can do inter-source and inter-head adjustment subject to the restrictions that we have studied. Possible. But if loss and profit belong to different years, then the loss and the profit should be of the same type. Only then set off is possible. The loss and the profit should be of the same head. Only then set off is possible. In the current year, you can do as you like, subject to section 70 and 71. But brought forward loss, to find the same type of income or find the same head of income. Chalo, keeping this in mind, let us quickly revise carry forward provisions. Salary, never a loss, so no concept of any carry forward, no inter-source, no inter-head, nothing. Salary can never have a loss only. House property, carry forward is possible for 8 years, has to be set off against income from house property only. In future, when you will take it forward, you can set it off against house property income only. Profits and gains of business profession. We saw that speculation losses require speculation profits only. Otherwise, you cannot set it off against other heads of income in the current year and you will have to carry forward. Carry forward is allowed only for 4 years. And even in those 4 years, it can be set off against speculation profits only. This is something that we are aware. This is the pattern that we follow for the current year also. This is the pattern that we will follow for brought forward speculation losses also. Loss from a specified business under 35 AD. I can set off that loss against specified business profits only. Cannot set it off against other heads of income. So now I will carry forward that loss. No maximum time limit allowed. This loss can be carried forward indefinitely. This loss can be carried forward for an infinite period of time. Today in 2020-21, I can set off a loss of a specified business which is belonging to the year 11-12, which is belonging to the year 10-11 also. The restriction of 4 years and 8 years does not apply. But yes, it can be set off against profits of specified business only. That restriction still remains. Third type of PGBP loss, non-speculation loss. Non-speculation loss carry forward for a span of 8 years and it can be set off against PGBP income only. But then under the head PGBP, I can have 3 types of profits. One, non-speculation. The other, speculation. And the third, specified business. No problem. All the profits are fine, are available. For non-speculation loss, you can set off that loss brought forward against the current year PGBP profit, which can be any PGBP, any business profit. Capital losses. Well, this is also not new for you. Carry forward period is 8 years. Short term that is brought forward can be set off against short term and long term both. This is something that we saw in the current year working also. But long term brought forward can be set off against long term capital gain only in the current year. And if I have loss from owning, maintaining race horses, carry forward period is 4 years. It can be allowed against profits. Set off is possible only against profits from same activity. Profits from same activity means profits from this activity of owning and maintaining racehorse only. Unabsorbed depreciation. You may have heard this, that unabsorbed depreciation is an expense remaining balance, remaining unabsorbed. It is not a loss, it is an expense. No time limit, infinite time available. You can set off this even after 10, 12, 14, 15 years. It can be adjusted. Important, I hope you remember this. It can be adjusted against any income. And when I say any income means all 5 heads of income. Of course, taxable incomes only, not exempt incomes. All 5 heads of income, including income from salary and including casual winnings. Losses, remember the word, losses cannot be set off against winnings. This is not a loss, this is an expense. Expense remaining unabsorbed can be set off against winnings. Non-speculation loss cannot be set off against salary. This is not a loss, this is an expenditure remaining unabsorbed, can be set off against salary income also. There is no restriction of 8 years or 4 years. It can be set off without any restriction of time. Lastly, a clarification. If you have loss under the head income from other sources, but it is not owning and maintaining racehorse, then that loss cannot be carried forward only, because there is no section created for it. There is absolutely no section created. That loss will lapse. So basically what I am trying to tell you is that loss can be covered by inter-source adjustment, possible. that loss can be covered by inter-head adjustment, that is also possible, but after that there is no section created for carry forward. So that loss you will have to forget, you will have to forgo that loss. Okay, quickly summarizing and giving you a last concept. We are talking about carry forward of losses. The losses can be carried forward for 8 years. Which losses can be carried forward for 8 years? House property can be carried forward for 8 years. Non-speculation loss can be carried forward for 8 years. Short-term capital loss, long-term capital loss can be carried forward for 8 years. 4 years. So speculation can be carried forward for 4 years only. Owning and maintaining racehorse wala loss can be carried forward for 4 years. And no time limit. This applies to loss from a specified business and unabsorbed depreciation. I'll rather change the heading. Instead of writing the word carry forward of losses, because unabsorbed depreciation is not a loss actually, I'll say this is a summary of carry forward periods. You can carry forward something for 8 years, 4 years, or no time limit. Okay, another section that is worth discussing, it is something very easy and I'm pretty sure the moment I write this you will remember. The section is section number 139.3. Now the moment you see 139, it means we are talking about filing of return. This section is applicable to loss under the head PGBP. All 3 losses are covered: speculation, non-speculation, specified. All 3 losses covered. It is applicable to short-term and long-term capital losses and loss under the activity of owning and maintaining racehorses. In the year of loss, if return of income is filed on or before the due date as mentioned under 139.1, then carry forward allowed, else carry forward is not allowed. This section 139.3 is putting a kind of a liability on the head of the assessee, that assessee, if you want your losses to be carried forward, the year in which you have suffered the loss, you ensure that you file your return of income on or before the due date, then we will allow you the carry forward as per the chapter of carry forward, otherwise carry forward is gone. This section 139.3 is not applicable to house property losses and unabsorbed depreciation, which means house property loss and unabsorbed depreciation can be carried forward in all situations, in all cases, whether return of income for that year is filed on time, is filed belated, for that matter, even if return of income is not filed, carry forward will be permitted. But for the 3 losses that are selected, PGBP, capital losses, OMRH, carry forward is subject to filing of return, that too on or before the due date. Chalo. So this is set of carry forward. Now let us pick up the third and the last concept for this video, alternate minimum tax. Chalo guys, alternate minimum tax. Now this is a CA final topic and the complications of CA final have been reduced and it has been brought down at CA inter. You can have a descriptive question from this particular topic. This topic can also come up in the form of MCQs. The topic is a very small topic. We might finish off the revision in about 15-20 minutes or maybe half an hour or so. There is nothing great. It is just that it was a CA final topic and is now brought down to the CA interlevel. So you just have to pay a bit more attention in understanding what the topic actually is and how things work. It says alternate minimum tax. So the word alternate means it is an alternate method to calculate income tax payable. It is the minimum amount of tax that you will have to pay. This is the bare minimum that the assessee will have to pay to the government. Now, first of all, does this concept apply to all assessees? No. This concept applies to all persons except companies. So to put it in accurate terms, individual will be covered, HUF is covered, partnership firm is covered, and we are aware that when we use the term partnership firm, it includes a limited liability partnership also. Association of person, body of individual covered, artificial juridical person is covered, local authority is not covered. The reason is very simple. At CA final you will study that local authority's income is fully exempt under section 10 clause number 20. So a local authority is not required to pay any tax only. So there is a question of an alternate method. Tax is only not supposed to be paid. So this concept is applicable to everybody other than company. Companies are not covered by this concept. Rule number 1. Rule number 2. AMT provisions will apply not for every partnership firm, not for every individual. Condition to be satisfied is, in the current year, it has claimed a deduction under section 10AA. Deduction under section 10AA means you have a unit in a special economic zone and you are claiming a deduction under section 10AA of export related profits. Then this concept of AMT is applicable to you. Second, either it has claimed 10AA or it has claimed a deduction under chapter 6A part C. Part C means you are getting deduction in respect of certain incomes, not in respect of expenses but in respect of certain incomes. So what are those deductions that we are talking about? Those deductions are section 80 JJAA, section 80 QQB, section 80 RRB. You have claimed any one of these deductions, or you have claimed a deduction under section 35 AD. 35 AD gives you 100% deduction of the capital expenditure that is incurred during the year. In simple terms, 100% deduction of the cost of fixed assets is allowed as a deduction under 35 AD. So you are a partnership firm which has either claimed a deduction you are a partnership firm which has claimed a deduction, just give me a minute. You are a partnership firm which has claimed a deduction under section 10AA or under section chapter 6A part C deduction 80 QQB, RRB, JJAA. So these two deductions are claimed from the gross total income. Or you have claimed a deduction under section 35 AD under the head PGBP. Then this is the condition. If it gets satisfied, then the concept of AMT applies. This is for partnership firm. For individual, HUF, AOP, BOI, artificial juridical person, same condition is applicable. 10 AA, 80 JJAA, QQB, RRB, 35 AD. But there is a second condition also. The adjusted total income should be greater than 20 lakh rupees. Now what do I mean by adjusted total income? This is the meaning of adjusted total income. You start with your total income. Now please pay attention to this computation. You start with your total income computed under the normal provisions. What do I mean by this? Gross total income minus deductions under chapter 6A, all type of deductions you will subtract, minus deduction under section 10 AA. This is your total income. You start with this amount. You add, basically you add back. You add back these three deductions. 10 AA deduction that you have taken, 80 JJAA, 80 QQB, 80 RRB, add back those deductions, add back 35 AD. Now 35 AD is capital expenditure, fixed asset cost. Because you were doing a specified business, under the head PGBP, you have already taken a 100% deduction of the cost of fixed asset. Now we are reversing that deduction temporarily. But the fact still remains that fixed assets are used during the year. So on those fixed assets, we will subtract depreciation under section 32. Remember when I say depreciation under section 32, what I mean is normal depreciation will be subtracted. If all conditions are satisfied, even additional depreciation will be subtracted. Depreciation under section 32 is allowed at half rate or at the full rate. So that concept will also equally apply. If you are talking about a fixed asset which is installed in a specified business, under PGBP computation, you have already taken a 100% deduction. Now, temporarily add back that deduction, reverse that deduction, and temporarily imagine that this fixed asset, if it was put into the block, what would be the depreciation deduction that I would get? Would it be at half rate or full rate? Would it be 10%, 15%, 40%? What rate would apply? Will I be eligible for additional depreciation also because that asset is used in manufacturing? So imagine that the asset was part of the block and calculate the block depreciation and reduce that block depreciation. After that, what you get is your adjusted total income, and this amount should be greater than rupees 20 lakhs. Then the concept of alternate minimum tax applies. If this is less than or equal to 20 lakhs, then the concept of alternate minimum tax is not applicable. Remember, here I am talking about all the assessees other than a partnership firm and other than a company, because the condition of 20 lakh rupees is not applicable to a firm. The condition of 20 lakhs is applicable to individual HUF, and that's why this so-called division that I have made is only for individual HUF, AOP, BOI, artificial juridical person. For those assessees, if your adjusted total income exceeds 20 lakhs, then the concept of AMT applies. Now, what is this concept of AMT? AMT concept is saying that on the adjusted total income, you calculate an alternate tax of 18.5%. Compare this 18.5% wala amount with your regular provisions. Regular provisions mean calculated as per slab rates. Slab rates meaning the slab rates announced by the Finance Act. Flat rate for a partnership firm, flat 30% rate applies. Special rates Special rates means rates of tax under section 111A, short term capital gain 15%, long term capital gain under section 112A and under section 112, winnings income under section 115BB. All these type of incomes, whatever special rate of tax applies, apply those rates. Under section 115BBE, you have to pay tax at the rate of 60% if you have certain undisclosed incomes like cash credit, unexplained investments, unexplained money, all that stuff. So those are my regular provisions. Calculate the tax as per the regular provision on your total income. If that tax is less than the alternate minimum tax, then for that year, whenever you use the word total income, it will be called as the adjusted total income, and you will pay your AMT calculated at 18.5% plus surcharge plus health education cess. Clarification, which is very easy to understand. Surcharge, we are all aware that surcharge applies if the income exceeds a particular limit. In this case, income means adjusted total income. So if adjusted total income exceeds the threshold limit prescribed, then surcharge will apply, not my normal calculation of total income. Now total income ka matlab is adjusted total income. If that adjusted total income exceeds the threshold limit, then surcharge will be calculated for that year, and that surcharge will be calculated on the AMT amount. Acha, by chance, if my tax as per regular provision is greater than AMT, that means I will pay regular provisions wala tax. Now it means total income computed as per the regular provisions. Surcharge will apply if the total income as per regular provisions exceeds the threshold limit. A student may also summarize it and remember something like this, that either it is tax as per regular provisions or it is alternate minimum tax. Out of the two, whichever is higher, this is finally going to be the tax liability. AMT ka M means minimum. So government is saying minimum, we want alternate minimum tax, AMT amount. If regular is less and AMT is more, pay us AMT. If AMT is less and regular is more, pay us the regular tax. A small point to remember here. When you do comparison between regular and AMT, comparison is to be done without including surcharge and health education cess. So comparison is to be done of regular tax and AMT, but those two amounts are going to be calculated without calculating surcharge and health education cess. Then you decide which one of the two has to be paid, regular or AMT. And the one that has to be paid, that will become the final tax liability, that is the amount to be paid. Then you decide what is the total income. Is it as per regular provisions? Is it as per adjusted total income? Then decide whether surcharge will apply or not. Then calculate health education cess. For your initial comparison, your comparison will be done of the basic amounts only. Basic tax as per regular provisions, basic tax as per AMT provisions, that is 18.5%. Then if you pay AMT, you will be given a AMT credit. You are paying something more than what the budget is saying. It is an alternate method. So government is saying no problem. Whatever extra you are paying is AMT credit. AMT credit is the extra tax that the assessee is supposed to pay, extra tax payable due to the AMT concept. It is because of the AMT concept that I am supposed to pay something extra. How much extra? That is called as AMT credit. So AMT credit means AMT amount minus regular tax. But remember, this time your AMT amount will include surcharge and health education cess. Your regular tax will also include surcharge and health education cess. When you do a comparison, you will not include surcharge, health education cess. You will do a comparison of the basic amounts only. If after comparison you come to a conclusion that AMT is supposed to be paid, then you will get a AMT credit. But that AMT credit will be calculated as AMT minus regular, AMT including surcharge health education cess, regular including surcharge health education cess. That is how the difference will be taken. This AMT credit will be carried forward for a span of 15 years. When you carry forward something, what do? You set it off. So when will you set it off? In a future assessment year, when regular tax is greater than AMT. Common sense question. If regular is greater than AMT, it means regular tax is payable. But then what will happen is, I will get a set off benefit, which means I will say that my final tax liability will be the regular tax minus the AMT credit which has been set off. But obviously, if I have to write something accurately, let me say brought forward AMT credit which is set off. This is the final tax liability for that assessment year. So what is AMT credit? AMT credit is the extra tax that I have paid due to the concept of AMT. No problem. That amount will be carried forward to future, and in a future year, that extra paid will be adjusted from your regular tax. So the extra that you have paid in the current year will reduce your future tax liability if in the future you are supposed to pay regular tax. Now remember that when the government is giving you that benefit, government will still ensure that it gets the minimum tax. So the amount of AMT credit that can be set off is as per this formula. Whatever is the AMT credit available in that assessment year, it could be a single year's AMT credit or multiple years ka AMT credit, whatever amount has been brought forward in that assessment year, or regular tax minus AMT for that year. Out of the two, whichever is less. Which means, beta, that this figure that you have na, tax liability for the assessment year, this figure, this will be either the amount of AMT or an amount higher than AMT, but never lower. It will be an amount which is either equal to the AMT amount or an amount higher than the AMT amount. But in every situation, government will still get the amount of AMT. I will write one more provision so that it is very common sense, but it will be like a clarification. AMT credit to be carried forward is going to be the AMT credit brought forward minus the AMT credit which is set off. balance AMT credit will be carried forward. It will be carried forward maximum for a span of 15 years. Now, last provision, a sensible amendment introduced. For our current budget, government has introduced 115 BAC and 115 BAD. What is this? 115 BAC is what is very popularly called as new tax regime, where concessional slab rates are applicable. 115 BAD, this is applicable for resident cooperative societies. You will not get a question based on this in your exams, but just for your knowledge, remember this small thing that I am mentioning. Your tax will be at a flat rate of 22%. There will be a mandatory surcharge of 10%, and but of course 4% health education cess. So 25.168% will be your effective tax rate. And remember this small thing. This is taught at the CA final level. It's an amendment, so just have a basic knowledge of it. 115 BAD is applicable to resident cooperative society. It is an option available that you can choose to pay tax as per this concessional rate. 115 BAC is applicable to individuals and HUF. But again, this is an option. Now the amendment introduced is, as I said, it's a very sensible amendment. If 115 BAC is opted for, the individual HUF decides, let me pay tax as per the concessional slab rates, then alternate minimum tax concept does not apply, which is quite logical. You are introducing a concessional tax rate and giving an option. But if you thereafter still say, I'm speaking from the government's perspective, if the government first gives you an option of paying tax at a concessional slab rate and thereafter says, okay, nahi, concessional slab rate nahi, ultimately to you will have to pay AMT, then you are defeating the whole purpose of introducing the concessional slab rate. Because if you are applying AMT, ultimately the assessee is paying AMT only. So what's the point of having these concessional slab rates? And therefore, if 115 BAC is opted for, then AMT concept does not apply. Which means you may also think like this, that if you pay tax as per Finance Act 2020, then either the tax as per Finance Act 2020 or alternate minimum tax. But of course, if the concept applies, that means you have taken a 10AA deduction, 35AD deduction, 80JJAA deduction, 80QQB deduction, 80RRB deduction, then out of the two, whichever is higher is what you are going to pay. But if 115 BAC is opted for, then alternate minimum tax is not applicable only. That means there is no concept of any comparison, and whichever is higher, then your tax will be as per section 115 BAC. This is the tax that you will have to pay. So mathematical concept AMT, it can come up as MCQs, it can come up as a small descriptive question also. For a partnership firm, it will apply if it has claimed any one of those three deductions. For individual HUF, AOP, artificial juridical person, it will apply if it has claimed one of those 3 deductions and the adjusted total income is about 20 lakhs. AMT is calculated at 18.5% on adjusted total income. If you pay AMT, you will get AMT credit, which will be AMT minus regular tax. That will be carried forward for 15 years. And in future, it will be set off when you are going to pay regular tax. But even after the set off, you will definitely pay AMT of that year or something more than that, but not less than AMT. Chalo. So this is the concept of AMT. In the coming videos, I will take up the heads of income, I will take up residential status also, and such small concepts. So I'll put an end to this video. This video contains 3 chapters: clubbing of income, set off carry forward, and alternate minimum tax. Chalo, happy studying. See you guys again. Goodbye.